Ladies and gentlemen, good day and welcome you all to the Q3 and NM FY2026 earnings conference call of Vikram Solar Limited. Please note that today's conference call is being recorded. The audio and content of this earnings call constitute proprietary corporate material of Vikram Solar Limited, may not be reproduced, redistributed or quoted in any public forum or media communication without the company's prior written approval. Please also note that any comment made during this conference relating to the company's future outlook that may be constituted as forward-looking statement should be reviewed in the context of the risk that the company is subject to. I now hand the conference over to Mr. Gyanesh Chaudhary, Chairman and Managing Director. Thank you and over to you, sir.
Thank you. Good evening, everyone, and thank you for joining us for Vikram Solar's Q3 and 9 months FY2026 earnings call. As we begin this call in the new year, I would like to take a moment to extend my warm wishes to all of you and your families. May this new year bring you Sukh, Samriddhi and Arogya, and may it be a year of clarity, balance and progress for all of us. At the outset, I would like to thank you for your continued confidence and support. We remain focused on strengthening our foundation across technology, governance and execution, while pursuing disciplined growth and a clear roadmap towards integration across the solar value chain. I would like to bring in a global perspective here. Globally, the clean energy transition has entered in a more industrial phase, where delivery capability, manufacturing credibility, and long-term resilience are increasingly shaping outcomes. Against this backdrop, India's energy transition and the role of domestic manufacturing take on a greater strategic importance for all of us. The next phase of this transition is increasingly systemic-led, shaped by convergence of generation, storage, and grid infrastructure rather than standalone assets. India's storage and green hydrogen ambitions will require significant scale-up in integrated renewable and storage capacity over the coming decade. This will shape demand patterns, technology choice, and capital allocation decisions. Now, coming back to Vikram Solar, Q3 has been an important quarter from an execution standpoint. We successfully commissioned and stabilized our 5 gigawatt advanced module manufacturing facility at Vallam in Tamil Nadu. This takes our total installed module capacity to 9.5 gigawatt. This facility is a key step in enhancing our scale, strengthening quality, and delivering reliability, and improving operating leverage as volumes ramp up. Along scale, our focus has been on strengthening the overall robustness of our manufacturing platform, ensuring consistency, reliability, and long-term value creation for customers across segments. We have continued to upgrade our product platform and have successfully transitioned to a complete portfolio of high-efficiency N-type modules. This supports our focus on bankability performance and long-term customer value across utility, C&I, and distribution segments. Subsequent to our Fab 4 commissioning at Vallam, our execution focus is firmly on Gangaikondan site, which will house 6 gigawatt of modules and 12 gigawatt of cells. This site is progressing as planned. As the industry transitions through ALMM List 2 for cell and the roadmap which has been given by the government for List 3 wafers, we believe depth in domestic manufacturing and supply chain resilience will become increasingly important. In this environment, agility and execution reliability are becoming as critical as cost competitiveness. Our objective remains to build a more integrated platform that can serve both domestic and non-domestic demand segments over time. While quarterly demand trends can vary, the broader environment for solar in India remains structurally very strong. Adoption continues to expand beyond utility scale projects into C&I and residential segments, and policy support continues to improve visibility for renewable growth over the medium term. Recent assessment by NICE indicates over 3,300 gigawatt of deployable ground-mounted solar potential, pointing to a long runway for solar deployment and domestic manufacturing across modules, cells, and integrated solutions. Furthermore, solar capacity has expanded more than 40-fold since 2014, positioning India as the world's third largest solar market. Now looking ahead, industry assessments project India to become the largest solar market globally in 2026, with over 50 gigawatt of new capacity additions, driven by primarily utility scale projects supported by continued policy backing for rooftop adoption. On the policy front, recent developments remain supportive. MNRE's move to progressively raise minimum efficiency threshold encourages technology upgradation. In addition, the draft renewable consumption obligation framework improves demand visibility, and fresh bids under advanced chemistry cell battery storage PLI schemes reinforce the government's push to build domestic capacity across generation, storage, and manufacturing. Recent changes in China's VAT export rebates could meaningfully alter price dynamics in selected markets. We view this as a constructive development that may moderate the extent of state-supported pricing and encourage greater cost discipline across the value chain. With our capacity now at scale and conversion costs improving, we believe our competitiveness across select export markets, which include Europe and MENA. This will strengthen and will enable more meaningful conversations with customers in these regions. We continue to view this opportunity as structural rather than cyclical, even as near-term demand patterns may fluctuate. The long-term runway for clean energy storage and integrated manufacturing remains very much intact. Companies aligned with integration, technology depth, and long horizon thinking, which are better positioned to navigate volatility and build enduring value. In summary, our priorities remain clear: consistent execution, disciplined capital allocation, and building long-term competitiveness through technology and integration. With that, I will now hand over the floor to our CFO, Mr. Ranjan Jindal, for a detailed financial walkthrough and an update on the three projects. Over to you, Ranjan.
Thank you very much, Mr. Chaudhary, and compliments of the season to all the participants who have joined us today. I am accompanied by Renal from our IR team and SGA, our IR advisors. We have uploaded our earnings presentation on the stock exchanges and the company's website. I do hope everybody had an opportunity to go through the same. We are happy to report a strong and resilient Q3 numbers that have contributed to cementing a formidable 9-monthly FY26 position. With 800 megawatt of sales volume, the YTD sales volume of over 2.3 gigawatts surpasses the full year sales volume of the previous fiscal by 23%. The company reported a healthy 9-monthly FY26 EBITDA of rupees 682 crores at 20.3% EBITDA margin, recording a 154% jump from the same period last fiscal. Before we delve into the financial and operational updates, let's go over into the important sector developments in the past quarter. During the quarter, India added approximately 8.5 gigawatt of solar capacity. On a cumulative basis, solar installations during the last 9 months reached around 30 gigawatts, taking the total installed solar capacity to 136 gigawatt as on 31st December 2025. Out of total 510 gigawatt of India's total installed power generation capacity, renewable sources currently account for 50%, underscoring the country's accelerating energy transition. Demand continues to be driven by utility-scale solar projects awarded through central and state auctions, increasing commercial and industrial adoption to achieve cost savings and decarbonization targets, and sustained growth in rooftop and distributed solar, supported by favorable policy measures like PM Kusum and PM Surya Ghar Muft Bijli Yojana. Under PM Kusum, Against the overall target of approximately 35 gigawatts by March 26, around 10 gigawatts has been installed as on 31st December 2025. Similarly, under the PM Surya Ghar Muft Bijli Yojana, approx 8 gigawatt of rooftop solar capacity has been installed in date. We will now discuss a few important ministry notifications. The Renewable Consumption Obligation Framework with unified target of 29.9% in 24-25 to 43.33% by 29-30, introduced via the Energy Conservation Amendment Act 2022 and formalized in late 2025, is a transformative policy shift. RCO provides a centralized, legally binding national mandate that will significantly accelerate solar adoption, shifting the focus to the actual consumption of renewable energy by designated consumers. The RCO categorizes distributed renewable energy that ensures investment into distributed solar assets, directly boosting the retail and rooftop solar segments. Another important NNRE notification regarding increasing the threshold of minimum module efficiency signifies a move to eliminate obsolete technology from the Indian grid. The minimum efficiency threshold is increasing from 20% to 21.5% by FY28 for utility scale projects, and the same for rooftop would increase to 21%. It is an intentional move by the ministry to weed out unnecessary build-out of less efficiency legacy systems. To put the numbers in more perspective, of the total 145 gigawatt of ALMM compliant module supply, only 78 gigawatt is capable of manufacturing more than 22% efficiency modules, which has a minimum 3 gigawatt plant size. The ratio is even more skewed in the ALMM list 2, where only 30% of the enlisted capacity is N-type capable. This implies that there is a significant scope for adding N-type capacities both in module and cell. MNRE in November had issued a letter to the renewable energy lenders to adopt a calibrated lending approach, shifting the focus to upstream manufacturing capacity. However, in early December, the ministry issued a clarification that there is no freeze on solar lending, but just a gentle nudge to incentivize vertical integration to ensure long-term energy security. The DGTR on 29 September 2025 recommended to the Ministry of Finance a levy of anti-dumping duty on the cells imported from China in the range of 23% to 30%, citing injury to the domestic cell manufacturers, which the Ministry of Finance had to act within 90 days of such recommendation. However, the 90 days period for the Ministry of Finance to pass the notification has lapsed on 29 December 2025, and there has not been any development on the matter. With respect to the ongoing investigation for the levy of anti-dumping duty for import of encapsulants from China, South Korea, Thailand, and Vietnam, no further findings have been published by the DGTR. From a policy standpoint, the ministry has remained committed towards encouraging establishment of indigenous manufacturing ecosystem. The upcoming enforcement of ALMM List 2 and the proposed ALMM List 3 strengthens the long-term visibility of domestic manufacturers with depth and quality. Last quarter, MNRE issued a draft roadmap to extend the ALMM framework upstream to ingots and wafers, with ALMM 3 proposed to be effective from 1st June 28, subject to a minimum industry capacity threshold of 15 gigawatt capacity by 3 uncontrolled players. We are currently evaluating the commercial viability and demand outlook for FY28 and beyond, and any capital deployment towards wafer manufacturing will be undertaken in a disciplined, phased, and technology-driven manner. We will share further updates as our internal assessments progress. Looking ahead, the horizon of the solar industry has never been more promising. While we navigate short-term supply chain realignment, the long-term fundamentals remain exceptionally robust. In the short term, we are navigating a tightening input cost environment driven by shifts in the Chinese supply chain, including polysilicon production controls, compounded by removal of 9% VAT export rebate from April 2026, which effectively shall raise the raw material cost. We view this as a constructive decision for the industry health, as it may reduce pricing distortions and support greater cost discipline. The company has started sourcing cells from Southeast Asian countries, thereby reducing China dependence. Furthermore, surging silver prices are placing pressure on the N-type cell input cost. However, new processes with new innovations in cell manufacturing like LECO, rare side usage of silver-coated copper paste, and other such initiatives are being explored in order to reduce the silver consumption per watt. It is, however, pertinent to mention that the module supply contracts signed by the company are designed to pass through the impact of such rising input costs to the consumers, since we operate in a cost-plus business model. Coming to the operating performance, the third quarter reflected a mixed operating environment. On a year-on-year basis, Q3 FY26 sales volume stood at 796 MW compared to 590 MW in Q3 25, supported by a stronger execution base built over the course of last 1 year, while revenues from operations increased to 1,106 crores, up from 1,026 crores in the same quarter last year. EBITDA for the quarter stood at 205 crores, translating into a margin of 18.5% compared to 85 crores and 8% in the corresponding quarter last year. Profit after tax for Q3 FY26 stood at rupees 98 crores against 19 crores in Q3 FY25. Looking at the 9-month period, performance remains robust and reflects the strength of execution in the first 3 quarters of the year. Sales volume of 9 months FY26 segregated to 2.3 GW compared to 1.1 GW in 9 months FY25, representing a significant year-on-year increase. Revenue from operations for the 9-month period stood at 3,349 crores, up from 2,230 crores in the same period last year. EBITDA for 9 months FY26 stood at rupees 682 crores with about 20% margins compared to 268 crores and 12% margin in 9 months FY25, while the profit after tax improved to rupees 360 crores from 49 crores last quarter. The effective capacity utilization for Q3 and 9 monthly FY26 stood at 90% and 88% respectively. These numbers emphasize the operating leverage achieved during the year and reinforces the underlying strength of our business model. During the quarter, we achieved an important milestone as highlighted by Mr. Chaudhary for the achievement of commissioning of our 5 GW advanced module manufacturing facility at Vallam in Tamil Nadu, taking our total installed module capacity to 9.5 GW. This facility has been designed as a highly automated, future-ready plant built on advanced and-tech technology with the flexibility to support next-generation upgrades over time. Beyond capacity addition, Vallam meaningfully strengthens our ability to deliver consistent quality, predictable timelines, and scalable volumes to customers across segments. One of the key highlights of this year is the improvement we have seen in cost efficiency as the business has scaled up. This has been driven by higher throughput, greater automation on the shop floor, and a tighter grip on indirect cost. Additionally, the newer capacity additions feature highly differentiated set of advanced automation systems that address some of the labor-intensive and quality-sensitive operations. From an operational impact standpoint, this framework delivers reduced manual touchpoints and significant reduction in the labor cost. Higher automation also results in stronger manufacturing yields, particularly during ramp-up and high-volume operations. We see this as a structural improvement in the business and an improvement driver of margin resilience as we continue to scale further. The company has continued to maintain a strong focus on optimizing its finance cost. Consequently, the weighted average finance cost of debt declined to 6.5% during 9 months FY26 from 7% in H1 FY26. This reduction was supported by disciplined cash flow management, improved credit profiles, and lender confidence, increased utilization of low-cost working capital facilities, and timely reset of interest rates in a declining rate environment. Turning to our order book, as on 9 months FY26, it stood at 10.58 GW compared to 8.2 GW in the same period last year, representing a year-on-year growth of 28%. The order book continues to be well diversified, with IPPs accounting for a significant share of approximately 55%, followed by a steadily increasing contribution from the C&I segment at around 21%. The government and EPC segments together contribute approximately 11%. In addition, our focused efforts to expand our distribution network through a growing base of distributors and dealers across the country reflect in our order book, with the distribution segment now contributing about 13%. The Gangaikondan project continues to progress as planned, with all statutory approvals in place and the core site infrastructure completed, including access roads, construction power, site offices, and civil works for both the module and cell facilities ongoing in full swing. Construction activities at the module plant are on way, with structural works and roofing in progress, and the facility remains on track for commissioning in Q1 FY27. At the cell plant, construction activities including foundation and substructure works are underway with critical long lead items of utility packages under finalization. We are thus on track for a phased commissioning with the first cell out in December 2026. Overall, execution remains aligned with defined milestones, and our focus continues to be on timely delivery and smooth ramp-up of these facilities. In line with our upcoming CapEx expansion, we are actively strengthening our human capital. Our headcount has increased from 1,587 employees in December 24 to 2,413 in December 25, reflecting the addition of skilled professionals across manufacturing, operations, and project execution to ensure smooth commissioning of our new facilities. During the quarter, we further strengthened our product portfolio with the launch of HyperSol Pro, our latest N-type module, which was unveiled at the Renewable Energy India Expo 2025. With efficiencies of up to 23.7% and power outputs of up to 640 watt peak, the product is designed to minimize internal energy losses, prevent reverse current, and enhance long-term energy output and module life. In addition to our financial and operational performance, we continue to receive strong third-party validation of our capabilities and market position. I am pleased to share that during the quarter, India Ratings upgraded our long-term bank facilities rating from IND A to IND A+ with a stable outlook, and also upgraded our short-term rating to IND A1 to IND A1+. This upgrade reflects our improved financial profile, disciplined capital management, and a strong balance sheet. We are also pleased to highlight the continued external validation of our operating capabilities. Vikram Solar has been recognized as a Tier 1 solar module manufacturing for the 8th consecutive quarter in the Bloomberg MEF bankability rating. To summarize, the results for the quarter reflect disciplined execution across the business, supported by scale, improved cost efficiency, and a continued focus on profitability. While near-term demand conditions remain dynamic, our strong order book, expanding manufacturing platform, and the supportive industry environment gives us confidence in the sustainability of our performance over the coming quarters. With that, we would be happy to take your questions. Thank you for hearing.
Thank you so much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question comes from the line of Ketan Jain from Avendus. Please go ahead.
Thank you. Thank you for the opportunity. First of all, congratulations on the commissioning of the module capacity. So just a clarification on the point you said that raw materials are a pass-through. So how is a typical contract with a client designed? Does it mean that all the raw material prices, like the cost of cell prices or cost of aluminum racks, are everything a pass-through? And also the forex deviation, since the INR has depreciated towards USD. So are all of these pass-through? Does the client pay you the difference in the raw material cost at the time of ordering and at the time of delivery? And how does the payment mechanism work with the client?
So I'll start with the payment terms. Most of the transactions are with big utilities, and these are all LC-backed transactions. In few instances, there are a part in advance and part in the form of LCs. On that pass-through concept, the pass-through actually is only for the cell, not the BOM always. And if we have a revisit of the order book as on 31st December, about 88% of the order book does have the pass-through benefit for the cell price only. BOM at times is required to be absorbed within the overall PL. So the balance 12%, so we are in view of reaching out to these customers to revisit the pricing with the increased numbers. And in fact, about inventory as on 31st December takes care of a bit of impact in the pricing. Over and above the cell pricing, a change in law, if that triggers in and that makes a impact on the input cost, that is something we can revisit to the customers and seek for a hike in the price.
So it has to be only if the customer agrees, or is it there in a contract? So can the customer dispute it?
No, that's what I told. The sell cost and the change in law is part of the contract.
Understood. So at the time of delivery, they will pay you a revised price based on the revised raw material cost.
Exactly.
Also, wanted to understand one thing. On the recent removal of export rebates by China, as you said, it makes us competitive in the global market. That I understand. But how does it impact us and the sector in a domestic perspective?
So it's one and the same thing, whether the increase in sell price for us for imports from China is on account of silver price going up or the export rebate going out. So this change in sell cost is a pass-through.
Okay. So if the change in sell cost is a pass-through, then the developers will be impacted. So, am I right to say that their IRRs for the project will get impacted because of this in the supply chain?
Maybe true, but we did not see, for example, in Q1 and Q2, there were softening in the prices as well. So maybe we'll have to talk to the developers to understand their overall economics. But I think over the project period, they average out their overall procurement, with some quarters being an increased cost and some lower than what they anticipated.
Understood. Just a last question, sir. We saw a reduction in margin sequentially. What would be the reason for that? And what would be the current DCR and non-DCR realizations in the country, in India?
So, this rationalization of EBITDA is not different than what we had anticipated in fact, in the last quarter. And even on a 9-monthly basis, the company has delivered an EBITDA of 20% plus. And going forward, we expect the non-DCR business to deliver 18 to 20% on a sustained basis.
Understood. And just the realizations, what are the current realizations in DCR and non-DCR market?
So with the current increase in cell cost, we expect the non-DCR to deliver a realization of 14 to 14.5 rupees per watt peak. And on DCR front, this change will not impact the DCR module price to go up. They still continue to remain at 23-24.
So that means the developers will be absorbing the increase in raw material price.
Yes.
Understood. Thank you, sir. I'll get back to the queue.
Thank you.
Thank you. Our next question comes from the line of Shivam Patel from PL Capital. Please go ahead.
Yeah, thank you for the opportunity. Is it possible for give us the split of your current capacity of 9.5 gigawatt into TOPCon and monoPERC?
Yeah, thank you, Shivam, for the question, but I'm glad to inform that the entire 9.5 gigawatt is TOPCon, and all our additions going forward, including the 6 gigawatt, would be TOPCon.
Okay, sir. Thank you. Yeah, I will get back in the queue.
Yeah.
Thank you. Our next question comes from the line of Sahil Seth from Anand Rathi. Please go ahead.
Hi, sir. So, my first question would be, there has been a severe drop of about 20% year-on-year in terms of realization, and even on quarter-on-quarter basis, there has been a steep drop. What are your comments on that?
So, maybe you're Sahil, right?
Yeah.
So, Sahil, our numbers are a bit different than what you highlighted. Yes, there was some dip of realization in Q3. If we are talking about non-DCR modules, there was an impact of about 30 to 40 paise. So that overall has kept the Q3 EBITDA a bit lower than what Q2 was. But on a 9-monthly basis, it continued to remain at 20% plus.
As Sahil, if you're comparing year-on-year realizations, in Q3 specifically, we had executed a DCR utility scale contract, because of which the realization, the blended realization was higher. That is the main reason. And this quarter, it has been 100% non-DCR execution.
Okay, got it. And one more, just to clarify, in our previous communications in the last quarter IP, our total module capacity goal was at 17.5 gigawatts, but now it has been updated to 15.5 gigawatts. Has the 2 gigawatts capacity plan to expand the Falta capacity has been cancelled?
No, we have not cancelled that. So we retained it at 15.5 for the timing to ensure 75% backward integration with the 12 gigawatt capacity plant. And going forward, since there is the country is moving towards ALMM2 cells being mandatory, we will have to revisit the decision of expansion of that 2 gigawatt, which we had planned in our existing facility in Falta.
Okay, sir. And in our opening remarks, you mentioned that you have been working to reduce the silver consumption on the cell front. Are there any currently viable technology or a substitute which would help us do that, or are those still under R&D phase?
Absolutely. So, Sahil, from what we hear from our partners who have been suppliers of cell for us, we hear that processes like LEGO reduces, it has a laser sharp precision, because of which your fingers footprint is so narrow that the overall metallization comes down. So that is in the short term a very viable option. There are, on a longer term basis, electroplating with copper with a nickel barrier also being considered. There is rare side usage of copper paste coated with silver also being considered, and on a global scale, Jinko and Aiko, global peers like that have successfully run commercial tests as well. So we feel that this is a huge catalyst for the industry to innovate and converge towards using better conducting polymers than silver.
Okay. Got it. Thank you so much.
Thank you.
Thank you. Our next question comes from the line of Harshit Patel from Equirus Securities. Please go ahead.
Hi. Thank you very much for the opportunity. So, firstly, on our outstanding order book, there is a reduction on the QOQ basis from the second quarter to the third quarter. So, was this because of the slowness in the industry, or we have removed some projects from our outstanding order book?
Harshit, the overall, there is of course the net addition, but our momentum of execution was higher. It has nothing to do with momentum in the overall space. We believe that the domestic order book that we carry is enough and adequate to carry us through the next 4 quarters, where we do not have a cell capacity. Parallelly, we have also started interacting with our consumers for DCR inquiries for delivery starting in the calendar year 27. So we believe it's an adequate order book, and this will continue. I mean, we do not see any dip in the interest or momentum from the customers.
Understood. Secondly, you mentioned about diversifying the sourcing of the cells from China to some of the Southeast Asian countries as well. So, could you highlight what is our current procurement mix in terms of China versus Southeast Asia, and how this mix will pan out over the next 2 to 3 years? That is my last question.
So currently it is heavily skewed towards China because they do have a cost advantage. But looking at the critical mass of supply now available in other Southeast Asian countries, we see a cost parallel being established, especially because the state-supported subsidizing of Chinese components is moving away, which is why we are acting ahead and have already activated conversations with our partners in the other countries.
Understood.
It is only a 1 year runway for us because after that we will have our own cell to back on.
Thank you.
Thank you. Our next question comes from the line of Nidhi Shah from ICICI Securities. Please go ahead.
Thank you so much for taking my question. So I saw in the PPT that you mentioned that the new 5 gigawatt line is a leased line. So I wanted to know what would be our yearly lease payment and what is the total lease on books for this line?
So we have taken this for a 400 crore debt financing. It's at 8.5% lease, and it would be apportioned over a period of 5 years, starting from this quarter. And on an annual basis, it will be 108 crores, which takes care of the interest cost on the liability also. So from income tax point of view, we get the directions for the entire payments for this rental.
So what is the rationale behind leasing a line for 5 years rather than putting up your own line that, could probably last you longer than that?
We could have done that, but at the time when we conceived this project, somewhere in FY2025, with a target to commissioning October, project finance would have taken a bit longer time. So this was a quicker deal for us to trigger. That was one. And second, we intended to keep the asset light as well. So with the right of use coming in the books of accounts, you don't directly add to the fixed assets. And third, with this structure also, there was no compromise or sacrifice on the income tax front, as I told you in the previous statement. So all these three factors basically motivated us to go for the lease concept.
All right. My other question would be on the export. So I see that about 20% of our order book is exports. Is it fair to assume that all of these would be modules where you are selling them fitted with Indian cells only?
Maybe 16% of our order book is from exports. Indian cells are unviable to use for exports because of the reciprocal tariffs imposed on India as a country, and hence a USLPA compliant and FEOC compliant supply chain from other Southeast Asian countries needs to be worked out and have a pre-approval from the CBP for us to be able to export to the US.
All right. So if you are essentially repackaging Southeast Asian cells, how do you see the outlook for the export order book going forward, given that there are a lot of other countries that are also doing this type of export, where they're purchasing from Southeast Asian countries where, where tariffs are not as much as India?
Maybe that universe has become a little smaller. The larger CMVT countries were imposed a similar sort of duty earlier in the calendar year of 25, which is why there is some capacity coming up in North African regions and other Asian countries, which we have been actively working with and are using them for USLPA compliant supply.
Okay. Okay. Lastly, my question is on TOPCon. Since our entire line is TOPCon, previously in the Indian market there was no price differential between monoPERC and TOPCon modules, not to say a meaningful extent. Are we seeing that distinction come in because of the difference in efficiencies? Are we seeing that there is a preference for TOPCon? Are customers willing to pay more for a TOPCon module?
So, hi Didi. The way market looks at technology, we've seen this over the last 2 decades evolve significantly. When you have a higher efficient product which delivers higher watt peak within the same area, offering better levelized cost of energy, the customer naturally pivots towards that higher efficiency product. Having said that, in the DCR market currently, we don't see enough TOPCon product available. So for the immediate term, PERC DCR probably would remain a product which will be valid. But as far as non-DCR is concerned, according to us, the market has completely pivoted or expected large manufacturers with significant capacity and control over quality and efficiency to deliver TOPCon only.
So are we seeing a price differential between monoPERC and TOPCon for non-DCR modules?
Non-DCR, as I said, there is hardly any expectation from the market of monoPERC.
All right. Thank you. Those were my questions.
Thank you. Our next question comes from the line of Akshay from UBS. Please go ahead.
Hi, sir. Thank you for the opportunity and really appreciate the industry insights and policy initiatives you shared at the start of the call. My question is regarding capacity expansions, particularly for cell manufacturing. So what's the status for the one capacity which is 9 gigawatt cell plant which is coming from Thailand and the organic expansion of 3 gigawatt which you are doing?
So, thank you. This 12 gigawatt plant project is being handled collectively, and the cell lines from Thailand will start getting fitted. It's a 4-month exercise from the start of dismantling up till delivery at site. We expect the clean room to be ready somewhere by September, October, thereby expecting the commissioning and first sell out by December 26. So considering that, shifting exercise should logically start somewhere in April, May, and the team is on track to get that done.
Got it. Thank you. And a follow-up question to this one. In the start of the call, you said you're moving all the modules to G12R module. All the capacity is now shifting to that. While Thailand plant, if we understand it right, it's based on M10 technology. So am I getting confused between two things, or what's the disconnect here?
No, Akshay, both of our upcoming cell plants will be capable of manufacturing both M10R as well as G12R cells. We spoke about the module portfolio being shifting to a more efficient G12R of our existing 9.5 gigawatt of module capacity.
Okay, right. So the Thailand line is already G12R capable. Got it. Got it. Thank you.
You may press star and one on the touchtone telephone. Our next question comes from the line of Sarang Jolekar from Vimana Capital. Please go ahead.
Yeah, thanks for the opportunity. So just wanted your view on the industry, how that we have seen that a lot of capacity, particularly in the module, has already come up. Do you already see any aggressive pricing by your competitors? And this quarter already there is some decline in your margins. So do you see further decline in your margins going forward?
Hi, Sarang. I wouldn't call a few basis point swing in the margin as a decline. You have to understand that quarter to quarter, our realizations depend on a particular set of execution that we have committed to. This particular quarter had a significant portion, about 30% of the order executed of government contracts that we had taken about a year back. So this is in absolutely a normal course of business. As to the over capacity or pricing pressure that you mentioned, we do not believe that in the customer circle where top 10 of our customers, about 7 out of 10 are repeat customers and are repeatedly granting the patronage to a credible name like Vikram Solar. We do not see that fight. And most of your overcrowding exists in the lesser efficient legacy systems. If you see the PowerPoint in the slide, we mentioned that the top 15 manufacturers control about 100 gigawatt of supply. And then there are 95 other manufacturers that control the remaining capacity of 45. That is where the overcrowding exists, and that would be mostly in the policy-driven mono-PERC supplies.
Understood. Thank you.
Thank you. Our next question comes from the line of Nikhil Abhyankar from UTI Mutual Fund. Please go ahead.
Thank you, sir. So just a couple of questions. I want to understand your outlook on the utility scale DCR demand in FY28, if you can.
Nikhil, so far after the threshold date of 1st September 25, we have seen RFSs of close to 20 gigawatt coming through, of which about one tender has given results. But looking and mapping each and every tender and its bid submission and result timeline, we believe that about 30-35 gigawatts plus kind of a utility scale or DCR demand will come through in fiscal 28. We are expecting a healthy pipeline of more RFSs to be announced in the coming quarters that will be adding to the utility scale demand.
Sure. And on the new capex of 44 odd billion, just want to understand the funding source for this.
So both these units collectively, which is the 6 gigawatt module and the 12 of cell, the overall funding would be for 6,400 crores, which would require a debt of 3,800, balance to come in the form of equity, of which part of the funds, about 1,500 has come in from the IPO. Balance will be taken care to the internal accruals.
On the best front, about best plans, yeah.
On the best front, the overall capex is at 4,300 crores. Based on a debt equity of 65-35, the financial closure for which is underway would fetch up 2,800 crores from the debt part, balance 1,300 crores over next 30 months. As of now, is planned to be funded from the internal accruals of the company.
Sure, sir. Sure. That's all from my side. Thank you.
Sure, Nikhil. Thanks.
Thank you. Our next question comes from the line of Bharani from AVDS. Please go ahead.
Yeah, good evening. Am I audible?
Yes, yes.
Yeah, this is Bharani from AVDS. So I was just wondering, in times of increase in module prices, this happened post-COVID also, developers put their projects on hold or delay their purchase of module given as orders have been given. So do you feel that this is happening now, starting to happen now?
So developers deferring the module offtake will trigger the levy of LD if there is any delay in the project. So obviously they will do their maths to determine as to whether they should go the deferment route and absorb the LD. But up till now, we have not encountered or seen any developer asking for a shift in the supply. And you could see that even in the last quarters, our production vis-a-vis sales have almost been at the same level, maintaining the same stock. So even for the current quarter, customer-wise mapping with regard to dispatches is all in place, and with payments in place, LC is coming on time. So we don't foresee any deferment as such on the module offtake front.
Okay. My second question is on, again, the utility scale demand. The awarding activity so far has been much lower than what we saw last year. So how are we confident of the 35 gigawatt of DC demand from utility in 28?
Currently, for the next 2 fiscals at least, we already have an addressable market of tendered capacity of about 104 gigawatt on the non-DCR side and a little over 15 gigawatts for the DCR side. So the installation run rate runs no risk of slowdown in the next 2 fiscals. For the demand beyond fiscal 28, like I said, the DCR RFSs have been issued to the extent of about 20 gigawatt already in the last quarter itself. And we believe a much healthier pipeline will come through in the coming quarters that will take care of the installation run rate beyond. And above and over and above this, we also have the 2 rooftop scheme driven installations that is picking up pace. plus the CNI adoption, which is going to be a game changer, along with, combined with storage. So we do not see any slowdown in momentum of installation, so to say, for the next 5 to 10 years. In fact.
Okay. Can you break down that 108 gigawatts of tenders? Is it adjusting for the around 40 gigawatts without PPA or?
So the 42 gigawatt, there has not been any official communication from the Ministry of their cancellation, so to say. But even if you were to remove them from the overall 120, you're still left with about 70 to 75 gigawatt of dam. And then you have the DCR demand to take over.
Got it. So, net of the 42, it is around 70. Yeah. And that 70 is, yeah, non-DCR, and that is the AC, right, you're talking about?
That is AC, absolutely.
Okay. Final question, how do we manage adverse movement of forex that has happened?
We do have a board-approved, well-defined forex policy, and we did a match to see that if you enter into a forward for the whole procurement, the 30-70 hedging policy takes care of the overall impact of the forex changes.
Meaning we have hedged?
Yes.
Okay, got it. Thank you.
Thank you. Our next question comes from the line of Sagar Parekh from Resonance Asset Managers. Please go ahead.
Yeah, hi. This is Sagar from Renaissance Asset Managers. So my two questions. One on the BESS side. So you said 4,300 crores of capex, right? So, so would you be like setting up the cells also, lithium-ion battery cells, or this is more like a battery pack unit that you're looking at?
So we will begin with the battery pack. That is the first plan of setting up 5 gigawatt hours, which will be commissioned in fiscal 27. And parallelly, we will begin work for a 7.5 gigawatt hours of integrated cell as well as battery pack facility.
So do we have a tie-up in place for the cells, lithium-ion battery cells?
Yes. We will be announcing it soon once it reaches a point of an update. For battery pack, getting cell supply is not at all a challenge. Technology partnership is also in advanced stages, and we will make an announcement soon.
Basically, just for my understanding, it will be 5 plus 7.5 total at full capacity of 4,300 crores capex.
No, it will be, once the cell capacity comes through, it will be an overall 7.5 gigawatt hour of addition. So in that facility, there will be a 2.5 gigawatt hour of additional assembly that will be set up.
Right. But that's coming for 40, we are trying to do the math here. Usually all these companies who have announced they are doing like 600, 700 crores per gigawatt, right? So 4,300, so that's coming up to, similar, 570, 600 crores kind of number per gigawatt capex.
Yeah.
And secondly, on this, wanted to understand on the silver part. So how big is the silver cost for us in the overall BOM cost?
For us, there is no direct silver cost because we import the cells as of today. But for a cell manufacturer, there was,
But the cell, cost inflation of cell is a pass-through for us, right? 88% of our order book, the cost inflation is pass-through, the cell inflation.
That's correct.
Yeah.
Then there is no price impact for us in that 88% of the order book.
That's correct.
Right. And lastly, probably for the next, we have given like only I think 10,000 plus crores of capex for the next 2 years, I believe. Can give us what is the capex number that we are looking at?
You have to repeat, please. We could not hear you properly.
On the CapEx side, 6,400 crores you said for the cell and module and 4,300 for the battery. So that comes to about 10,000 crores of CapEx that is to be put in the next 2 years. If you can give us breakup like FY26, how much are we looking at? 27 and 28, 3 years, what is the CapEx number that we are looking at?
So in total, this CapEx will be spent over next 24 to 30 months, and the equity requirement for this collectively would be at 2,400 to be fetching from the internal accruals which the company shall earn gradually hereafter.
Right. So how much is the CapEx that we have done 9 CapEx till now?
Up till December, we have spent approx 300 crores.
And Q4 will be approximately?
So this figure collectively should touch 1,100, something like that.
Oh, so now Q4 will be CapEx heavy, probably 900 crores of CapEx.
Yeah.
Got it. Okay, that's it from my side. Thanks.
Thank you.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our next question comes from the line of Darshil Jhaveri from Crown Capital. Please go ahead.
Hello. Good evening for taking my question. Good evening, and thank you for taking my question. Hopefully, I'm audible.
Yes, very clear, Darshil.
Yeah. Hi, sir. So, sir, a lot of my questions have already been answered. I just wanted to, get a sense of, the order inflow. Like, so in FY27, like, what order inflow are we seeing? Because, like, I think our capacities will be fully utilized. Like, our current book will be fully executed in like a period of next 4 quarters. So, what's the target for FY27, sir?
So the target for us is always on a rolling basis, having a 1.2 or 1.3 times my scheduled deliveries for the next 4 quarters. And hence in fiscal 27, that would be the target that we'll be working into.
So I think in FY26 we have around 9.5 gigawatts. So roughly 14 to 15 gigawatts, that would be our rough, right? Like if I could. That would be okay. Fair enough. And so, where do we see these order flows coming majorly from, like government or IPP, or that? Just wanted to understand about that.
If you see the order book split, it's a good mix that we have. IPPs account for about 50% of our order book. Government is a very periodic, sporadic percentage. As in when the tenders come, their proportions keep on changing. What is more important is the C&I and distribution now account for a significant portion. So we will be focusing our energies on these segments.
Okay. So, but in FY27, we see more focus from non-government, if that would be a fair assumption, ma'am.
Yeah, that should be. Yes.
Yeah. And just last question from my end. So, post, like, when our cell manufacturing comes into play, how do we see, the export market? Like, we, I think assuming tariffs, we have a trade deal in place or something, by FY27. So, how do we categorically see, how our export potential?
So, I think India has achieved significant critical mass in terms of manufacturing now, and considering that there is ample access to technology, capital, as well as economies of scale for manufacturers like us who are gunning for excess of 10-15 gigawatt of capacity. We would be looking at competing with China at a global scale going forward. So we don't see a challenge there trying to bid and win large orders and accessing markets like Europe, MENA. You're right, current tariff regime is creating a bit of a challenge, but ultimately the market is still very strong. Solar deployment is still very, very strong and robust. because the overall cost of energy is unmatched to any other form of energy. So there are adequate policy measures taken by several governments in place which support solar deployment in spite of all the narratives. So if India remains competitive, we should have access to all the markets globally.
Okay. Fair enough. Yeah, that's it from my side. So thank you so much. All the best.
Thank you.
Thank you. Our next question comes from the line of Prakhar Porwal from Ambit Capital. Please go ahead.
Hello, am I audible?
Yes, Prakhar. Please go ahead.
Sir, just two clarificatory questions. One is when you say you import cells from Southeast Asia to export modules to US. So as per FY2025 restrictions, does the Chinese value addition is limited from cell and import, or does it apply to wafer polysilicon also?
No, I see. It is non-Chinese from the wafer onwards, but more important than that, no sourcing of polysilicon also from the Xinjiang region. So USLA is now the stricter benchmark to source any sort of value chain from anywhere.
So maybe the Southeast Asian cell producer would be maybe sourcing it from somewhere else and then producing wafer and cell and you're importing cells from there.
That's correct.
And second thing is, when you say in the opening remarks when sir said that you're shifting some of the purchases to Southeast Asia for cells given to move away from maybe Chinese purchase. So anyway, since 88% of order book is a pass-through, at least in cells, so what is the rationale for maybe shifting that? And I would assume cells from Southeast Asia would be costlier.
So nothing like that. And the whole purpose of making a shift from China to Southeast Asia is not entirely commercial. It's always good to have diversified sources from the volume point of view also. And let us not forget, Chinese cells do attract levy of BCD to the extent of 27.5%. And cells from all these non-Chinese South Asian countries that landed pricing point of view continues to remain the same almost.
Understood. Okay, sir. Those are my questions. Thank you.
Thank you.
Thank you. Ladies and gentlemen, due to the time constraint, that was the last question for today. I would like to hand the conference over to the management for the closing comments. Thank you, and over to you, sir.
Thank you very much. Thank you all for joining us today. I hope we were able to address all the questions. We remain committed to keeping the investment community informed with regular updates on the developments of the company. For any further queries, if they were left unattended today, please feel free to reach us or SGA, our investment relations advisor. Thank you all of you to remain connected and allowed us taking us through the operations of the company. Thank you very much.